Hey everyone, welcome back. Today, we're going to talk about a topic that's been on a lot of people's minds lately, interest rate cuts. Now, you might be wondering why this is important and how it could impact you. Well, stick around because we're going to break it down and make it super easy to understand. So, the Federal Reserve, which is basically the central bank of the United States, has been holding meetings about possibly cutting interest rates. This might sound a bit technical, but it actually affects a lot of things in our daily lives, like the interest rates on our loans, credit cards, and even the economy overall. To give you some context, interest rates are kind of like the price of borrowing money. When the Fed cuts these rates, it becomes cheaper to borrow money. This can lead to more spending and investing, which can boost the economy. But it's a bit of a balancing act because cutting rates too soon or too late can have different effects. Right now, the Fed is considering a rate cut for the upcoming September meeting. They've been cautious about making this move because they want to see solid evidence that inflation is cooling down and the labor market is stable. Inflation, which is the rate at which prices for goods and services rise, has been a bit of a headache recently. But the good news is it's starting to slow down. For instance, a measure of underlying inflation that excludes food and energy prices has dropped significantly over the past year. This is a positive sign and suggests that we might be on the right track. However, the Fed wants to be absolutely sure before they make any decisions. They're also keeping an eye on the labor market, which is showing signs of cooling off. The unemployment rate has increased slightly, and it's taking people a bit longer to find jobs. This means that the pressure for wages to rise and potentially cause more inflation is easing. Now, you might be thinking, how does all this affect me? Well, if the Fed decides to cut interest rates, it could mean lower rates on things like mortgages, car loans, and credit cards. This could make it cheaper for you to buy a home, finance a car, or even pay off credit card debt. Lower interest rates can also lead to higher stock prices because investors might move their money from bonds to stocks, looking for better returns. But it's not just about the positives. There are also some risks involved. If the Fed cuts rates too soon, it could lead to inflation picking up again. On the other hand, if they wait too long, we might see higher unemployment and slower economic growth. So, what's the Fed's plan? They're playing it safe and waiting for more data before making any moves. They want to avoid the mistakes of the past where they either acted too quickly or waited too long. This cautious approach is meant to ensure that they strike the right balance between fostering economic growth and keeping inflation in check. In the next few weeks, we'll get more updates from the Fed, and by September, we should have a clearer picture. For now, it's all about staying informed and understanding how these decisions can impact our finances. Thanks for sticking with me through this discussion. If you found this helpful, make sure to like and subscribe for more content like this. And leave a comment below with any questions or thoughts you have about interest rates. I love hearing from you and engaging in these important conversations. See you next time.